US and Chinese officials are set to hold a second day of negotiations later today as they try to de-escalate the ongoing trade war. Delegations from the two economic superpowers met in Geneva on Saturday to discuss a possible lowering of tariffs.
Welcome back to the Government Report. In 2018, then-President Donald Trump launched what would become one of the most aggressive trade offensives in modern history, a full-scale trade war with China. Trump's message was clear. America had been losing for decades, hemorrhaging jobs, intellectual property, and global influence to what he called an unfair and abusive Chinese economic model. Tariffs quickly became his weapon of choice. Billions of dollars worth of Chinese goods were slapped with steep duties, and China retaliated in kind, triggering a tit-for-tat economic conflict that shook global markets. Fast forward to 2025, and that economic Cold War hasn't cooled. It's intensified. The Biden administration briefly explored de-escalation, but with Trump's return to the political spotlight and his influence over GOP-led trade policy, the tariff war roared back with renewed energy. By early 2025, the U.S. had imposed tariffs as high as 145% on some Chinese imports, while Beijing responded with 125% levies on American goods. Yet just this weekend, after so much of rising tension, high-level negotiations resumed in Geneva.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%.
For the first time in years, both sides agreed to sign a deal to reduce tariffs on both sides. But the question now is, are we finally at the brink of a breakthrough, or is this just the eye of the storm? The Geneva talks.
So there was very good personal interaction. Both countries represented their national interests very well. We concluded that we have shared interest, and we both have an interest in balanced trade.
On May 10th, 2025, the world's financial markets paused and watched as the US and China, the two titans of global trade, stepped back into the negotiation room. The setting? Geneva, a neutral, symbolic location for diplomacy. But this wasn't just another round of empty political theater. This was the highest-level face-to-face discussion between American and Chinese officials in nearly 2 years, following an intense escalation in tariffs and rhetoric. Leading the charge for the United States was Treasury Secretary Scott Bessent, known for his hawkish stance on Chinese market manipulation, alongside Trade Representative Jamieson Greer, a veteran of Trump's first-term trade team. Facing them across the table were Chinese Vice Premier He Lifeng and Public Security Minister Wang Xiaohong, two of the most influential architects of China's economic policy. The stakes could not have been higher. The United States had recently raised tariffs to an unprecedented 145% on a wide range of Chinese imports, including electronics, steel, and pharmaceuticals. In return, Beijing responded with 125% tariffs on American agricultural exports, semiconductors, and automobiles. The result? Skyrocketing consumer prices, disrupted supply chains, and a growing anxiety among global investors. But this weekend in Geneva, something shifted. During the Geneva talks, both the US and China made a breakthrough in their trade fight. President Trump said the talks led to a total reset in trade terms, helping calm down the serious tension between the two countries. The agreement included big cuts in tariffs. US tariffs on Chinese goods dropped from 145% to 30%, and China lowered its tariffs on US goods from 125% to 10%. While some tariffs were paused instead of removed, Trump said he didn't expect U.S. tariffs to go back to their previous high levels. He also said China was ready to make a deal because its economy was suffering, factories were closing, and there was unrest. The deal brought a positive reaction from investors. U.S. stock markets jumped, with the Dow Jones and S&P 500 rising more than 2.5%, and the Nasdaq going up 3.3%. European markets and Hong Kong's Hang Seng Index also rose. Shipping companies like Maersk and Hapag-Lloyd saw their shares climb sharply. Even though the deal was seen as a big step forward, experts warned that trade between the US and China will still be more expensive, with US companies and consumers likely paying the price. Still, both countries said they don't want to fully separate and plan to keep talking to solve their problems. They also agreed to set up a team, led by Scott Bessent from the US and Vice Premier He Lifeng from China, to keep the conversation going. The deal also comes as part of Trump's bigger goal to fix what he sees as unfair trade. He believes the US buys much more from China than it sells and is unhappy with issues like stolen technology and unfair support for Chinese companies. While the tariffs were meant to protect US jobs, many economists say they've hurt global growth and raised prices. The International Monetary Fund even cut its forecast for world economic growth, saying the uncertainty from the trade war is causing companies to slow down or stop investing. Economic impacts and strategic calculations. The economic toll of the US-China trade war is no longer theoretical. It's visible in everyday life, from grocery aisles in Ohio to factory floors in Guangdong. Over the past few years, the barrage of tit-for-tat tariffs has created a cascading effect on both countries' economies. American farmers, especially in the Midwest, have watched export orders vanish almost overnight. Crops once destined for Chinese ports now rot in silos, while government bailouts try, and often fail, to cushion the blow. On the industrial side, U.S. manufacturers have faced ballooning input costs due to tariffs on Chinese raw materials, creating a margin squeeze that's forced layoffs, plant closures, and outsourcing to non-tariffed nations. China, meanwhile, is far from unscathed. Key export sectors, particularly electronics, machinery, and automotive components, have suffered from falling U.S. demand. Chinese supply chains, once optimized for efficiency, have been thrown into disarray. American tariffs have disrupted critical flows of materials, making production costlier and timelines less predictable. To make matters worse for Beijing, foreign firms are starting to look elsewhere, shifting production to Vietnam, India, or even back to the US in a process dubbed de-risking from China. But make no mistake, both countries are playing the long game. For the United States, the strategy is about leverage. By applying economic pressure, Washington hopes to force China to adopt fairer trade practices, especially on issues like intellectual property theft, currency manipulation, and state subsidies. For President Trump, it's also a political statement. America First means fighting back against what many perceive as decades of one-sided globalization. China, on the other hand, views the standoff as a test of sovereignty. From Beijing's perspective, bending to U.S. economic pressure sets a dangerous precedent. The Chinese Communist Party wants to project strength, both to its citizens and the world, and retreating now could be interpreted as weakness. So what we're seeing isn't just a trade dispute, it's a geopolitical chess match with trillion-dollar consequences, challenges, and opportunities. So why Geneva? According to insiders, the choice of location was strategic, a nod to traditional diplomacy and a break from the volatile back-channel tactics that had defined much of the US-China trade relationship under Trump's first term. It also gave both sides political cover. Neither country was seen as conceding power by hosting on home soil. While the Geneva talks offered a glimmer of hope, the road ahead remains riddled with diplomatic landmines and economic uncertainties. Behind the smiles and handshakes, deep-rooted mistrust still simmers between the two superpowers. The U.S. delegation, led by Treasury Secretary Scott Bessent. On the other side, China's negotiators, including Vice Premier He Lifeng and Public Security Minister Wang Xiaohong, view the U.S. demands as intrusive. Beijing maintains that any meaningful progress must begin with a goodwill gesture, namely a unilateral reduction in American tariffs. For the Chinese leadership, particularly under President Xi Jinping's increasingly nationalistic regime, conceding too early or appearing weak in the eyes of its domestic audience is politically untenable. This tit-for-tat deadlock underscores the complexity of modern geopolitics, where trade is entangled with security, sovereignty, and technology. And although the Geneva meeting was hailed as a reset, both sides are cautious about overselling its outcome. Both sides agreed to stop most of the Liberation Day tariffs for 90 days and completely cancel the extra retaliatory ones. China also promised to remove non-tariff barriers. However, U.S. tariffs still include an extra 20% aimed at pressuring China to stop the illegal fentanyl international trade. Still, embedded within these challenges are enormous opportunities. A reduction in tariffs could stabilize global markets, lower consumer prices, and boost investor confidence, especially in the tech and agricultural sectors. Small and mid-sized American businesses reliant on Chinese manufacturing could see cost relief. Chinese exporters, facing declining demand, could regain access to their largest customer base. Even Wall Street showed early signs of optimism, with markets responding positively to news of the Geneva talks. But all of that hinges on what happens next. Will cooler heads prevail? Or will political pressure, nationalism, and a looming U.S. election derail the fragile progress? The next few months will be critical. One misstep, one inflammatory tweet or policy reversal could plunge U.S.-China relations back into chaos. But if both sides seize the moment, a new era of cautious cooperation might just be possible. Global implications and future outlook. The impact of the ongoing trade negotiations between the United States and China goes far beyond just two countries trying to reach an economic agreement. What's happening at the negotiation tables in Washington and Beijing is being watched carefully by governments, businesses, and investors all over the world. This is not just about tariffs or imports and exports. It's about setting the direction of global trade in the years to come. Countries in Europe, Asia, Africa, and the Americas are all keeping a close eye because the decisions made by these two economic giants will influence the rules everyone else has to play by. The outcome of this trade standoff could mean a complete reshaping of global supply chains, pricing structures, and trade routes. Companies that rely on stable, predictable international commerce are now forced to adapt to an environment full of uncertainty. They are recalculating their strategies, trying to anticipate whether they'll need to shift manufacturing to new locations, raise prices due to tariffs, or brace for sudden market fluctuations. Even small businesses, which once may have seemed far removed from global trade policy, are now caught in the ripple effect. Whether they import materials, sell products internationally, or just depend on a stable economy to thrive. One of the biggest problems facing global markets right now is the lack of predictability. Investors and business leaders crave consistency, and without it, confidence shrinks. While the recent talks in Geneva gave the world a moment of cautious optimism, there's still a deep sense of hesitation. The fact that the US and China are engaging in dialogue is encouraging, but the absence of any solid or long-term agreements keeps the entire global economy in a state of limbo. For example, leaders in the European Union are carefully calculating how a potential deal, or lack of one, might affect their own trading position. Europe may find itself with more leverage if the US and China remain in conflict, or it may be squeezed out of key markets if a US-China deal reshapes alliances. Meanwhile, countries like Vietnam, Mexico, and India, which have gained from the trade war by picking up manufacturing and export businesses that previously went to China, are unsure of their future. If the US and China strike a deal and restore old trade patterns, those benefits could disappear overnight, leaving these countries scrambling to adjust again. On a broader level, this conflict is also testing the relevance of major global trade institutions like the World Trade Organization, WTO. For decades, the World Trade Organization has provided a platform for resolving disputes and maintaining fair global trade practices. But in recent years, its influence has waned, especially as more powerful countries prefer to make direct, bilateral deals instead of following multilateral rules. The outcome of this trade conflict could either help revive the WTO's role if both nations agree to return to a rule-based system, or further weaken it by showing that strong countries can get what they want through pressure and power. This shift away from international cooperation and toward individual bargaining could set a troubling example for the rest of the world, leading to more trade conflicts and less global coordination in the future. And then there's the everyday consumer, who might not follow the headlines closely but will feel the effects. If a resolution is reached and tariffs are lifted, it could bring down prices on a wide range of products, from smartphones and computers to clothing and household goods. That's because fewer trade barriers usually mean cheaper manufacturing and smoother supply chains. But if talks collapse and both countries dig in their heels, we could see a new wave of tariffs and counter-tariffs that drive prices up even further. For consumers already dealing with inflation and rising living costs, this would only add more pressure. Limited product availability, longer shipping delays, and higher retail prices could become the new normal. In short, what happens between the US and China doesn't stay between the US and China. It affects families, workers, and businesses in every corner of the globe. In short, what happens next between the US and China won't stay between the US and China. It will reshape how countries trade, compete, and cooperate in a rapidly evolving world economy. The Geneva talks may be the first chapter in a new story, or merely a pause before another economic storm. Only time and strategy will tell. What do you think about this? Share your thoughts in the comments section. Like and share the video, and follow us for more. Thanks for watching.